Hi everyone and welcome to Montaka's video update for the September quarter of 2024. The businesses of Montaka's largest portfolio investments continued to perform extremely well during the quarter, and their competitive advantages continued to improve. We believe the businesses in Montaka's portfolio are substantially more valuable than their stock prices imply today. So while many investors fret about markets being too high, we continue to see quite a few significant investment opportunities in global equities today. And you can look no further than Montaka's top 10 for clues on where we think the big opportunities are. So as you can see, Montaka's biggest holdings include KKR, Blackstone, Amazon, Microsoft, ServiceNow, S&P Global, Meta, Spotify, Tencent, and a new investment in Floor Decor, which is a big box specialist hard surface flooring retailer in the US, which I'll come back to in a few moments. And it's important to underscore that as a high conviction investment manager, these top 10 holdings account for 75% of Montaka's total portfolio. So what I'd like to do now is spend a moment on 4 key areas in which we see substantial investment opportunity today. Now, Blackstone and KKR have been successfully investing their clients' capital for many decades. In the case of Blackstone, it's almost 40 years, and KKR has been in business for almost 50 years. These are extraordinary investment managers. They have globally recognized brands, great track records, and they are uniquely advantaged in their access to talent, to capital, and the best deal pipelines all around the world. Now, the alt space is growing rapidly, driven by growth in 3 underpenetrated markets. So there's Asia, there's the insurance sector, and there's the enormous private wealth channel. And we think this growth will be captured disproportionately by the industry leaders. And in fact, we can already see that is happening today. So if we're right, we would expect to see substantial acceleration in the growth of earnings at Blackstone and KKR. We don't think the market is adequately reflecting this, meaning we continue to believe that the shares of Blackstone and KKR remain undervalued. The market for cloud computing is more than $250 billion excluding China, and is growing at approximately 25% per annum. Yet it represents only around 15 to 20% of the total IT workloads today, with the remaining 80 to 85% of workloads still residing on-premise. Now, we think this ratio will slowly flip over time, given the compelling attributes of cloud-based computing, including better cost and better security. And it's also worth underscoring that the AI revolution is overwhelmingly native to the cloud. So this represents an additional wave of demand for the cloud. Now, we think the most attractive feature of the cloud computing space is its high market share concentration. So that is the top 3 players, including Amazon, Microsoft, and Alphabet, account for at least 65% collective market share. And then combined with the very high barriers to entry, given the really high capital costs, the really significant R&D spend that takes place, this industry and these 3 players really are protected from competition. So as demand for cloud computing grows structurally, we believe we already have a pretty good idea as to who the long-term winners will be. And yet we think the market continues to underappreciate the long-term durability and therefore value of the revenue and earnings growth that will follow for the likes of Amazon, Microsoft, and Alphabet. Montaka owns several duopolies in the financial services industry, including Visa and MasterCard in payments and S&P Global in credit ratings and financial data services. Now, these businesses have competitively protected and reliably growing core businesses, but they also have new, higher probability adjacent opportunities. Again, though, we think the market continues to underappreciate these powerful combinations. So for Visa and MasterCard, their core businesses in global payment processing are being complemented by significant growth in 2 areas. So number 1, new payment processing opportunities with respect to peer-to-peer, business-to-business, business-to-consumer, and government-to-consumer payments. And then number 2, complementary value-added services to the existing customer base. So we're talking things like risk, fraud detection, acceptance, issuance, and open banking. For S&P Global, we are seeing a cyclical rebound in high-margin credit ratings, and at the same time, the company's software services businesses are rolling out an expansive pipeline of new AI-enabled product features powered by S&P Global's large and unique datasets. To win in AI, we think investors need to look through the hype of all the new whiz-bang technologies and instead focus on enduring business advantages. Now, two really important advantages here are, number one, the ownership of privileged datasets at scale, and number two, a distribution channel in the form of a captive customer base through which new value-adding AI services can be distributed. With today's language models alone, we think enormous value can be unlocked on the enterprise side through productivity enhancements and on the consumer side through engagement boosters such as Facebook's personalized content recommendations and also new product features. But in most instances, the real magic happens when you marry the AI models with customer data and also, importantly, the metadata around the customer data. So this metadata gives the language models the context and grounding they need to be effective for their desired use case. Now, these dynamics favour incumbents who have already been building datasets for decades and who have existing customer bases into which they can distribute new value-adding AI services. Both of these business advantages are nearly impossible for competitors to recreate, and this means they are likely an enduring source of long-term value creation for investors. Montaka owns ServiceNow and Salesforce as advantaged owners of unique datasets that are mission critical for near-term value-adding AI distribution for the world's enterprises. And on the consumer-facing side, Montaka owns Meta and Spotify for many of the same reasons. And we think all remain underappreciated by the market today. There has been a lot of focus on the outlook of the global economy and what that means for markets, but the global economic backdrop appears quite favourable for equity investments. In the aggregate, growth in the US remains pretty solid. There is some notable weakness in lower income household consumption, and growth abroad, including in the UK, EU and China, is also pretty weak. But interestingly, these weaknesses carry a silver lining. They are disinflationary. Now, this has helped US inflation to continue to decelerate, which has allowed the Fed to recently commence an interest rate easing cycle. And in China, the PBOC recently followed suit as well. So when you combine solid US aggregate growth, falling interest rates, and reasonable equity valuations, it makes global equities fertile ground for investment opportunities, in our view. And yet, as you know, markets have experienced some volatility of late. So in August, investors experienced the biggest one-day spike in the volatility index in 30 years, while Japan's Nikkei equity index dropped 12% in a day, its largest single-session drop since Black Monday in 1987. Now, as uncomfortable as volatility can feel, it provides opportunities when short-term stock prices decline and become divorced from the intrinsic value of their underlying businesses. I want to now briefly touch on two ways in which Montaka took advantage of stock price volatility during the September quarter. In early July, we established a new position in Floor Decor, which, as I said, is a big box specialist hard surface flooring retailer in the US, and whose stock price had declined by more than a third during the preceding months. Now, to us, the salient feature of Floor Decor is its flywheel dynamic that builds and strengthens its scale advantages while reducing prices and increasing value for customers over time. The business has been working on each of these elements of its flywheel for many, many years now, and we can see their competitive advantages continue to strengthen. There is also a really attractive rollout story here. The business has only 230 stores in the US today, so there is ample room for Floor Decor to expand to their target of more than 500 stores over the coming years. And importantly, the unit economics of each store are extremely favourable. And we think it's a really attractive time to own Floor Decor now that the Fed has started to cut rates. we expect the US housing cycle will now flip from being a headwind to being a tailwind for this business. And the other way we capitalized on volatility during the quarter was to add to Montaka's position in Amazon following its near 20% stock price drawdown. And to fund this addition, we sold some of our holdings in two tactical positions in the tail of Montaka's portfolio. And so that is AMD and Kyndryl Holdings. Now, this is not to say that we don't still like AMD and Kyndryl. We do. We still see plenty of upside in these names. But we think Amazon has even greater upside and with more certainty. So it simply demanded more capital at the expense of other names in Montaka's portfolio. This quarter, we also have a special announcement to make. We are honoured to share that MFF Capital Investments has announced its intention to acquire Montaka. Now, MFF is an independent Australian ASX-listed company with net assets of more than $2 billion. And MFF is led by Chris Mackay, who I'm sure needs little introduction as the co-founder of Magellan. Now, what you may not be aware of is that Chris is also the largest unit holder in Montaka's funds, right alongside you. And because of this, Montaka has had a close relationship with MFF for many years now, and collaborating in the background wherever we can. Now, MFF and Montaka share a common investment philosophy. So given this, it may not be surprising to observe at least 8 investee companies common to both portfolios. And this represents more than 60% of MFF's portfolio by value. So we think this is great news for you. Under Montaka's new arrangement with MFF, you will continue to benefit from Montaka's funds, strategies, and philosophies. And importantly, Montaka's entire team, including myself and Chris Damasi, will remain running the funds. And in response to the acquisition, Montaka unit holders are not required to take any action. So there's nothing for you to do. We simply wanted to share with you this good news. We remain highly optimistic about the prospects of Montaka's investee companies. As their competitive advantages continue to improve, we think they will continue to underpin substantial investment returns for Montaka's investors over the coming years. And of course, that includes us. Montaka's principals, and indeed our whole team, remain substantial co-investors alongside you in Montaka's funds. So on behalf of the entire Montaka team, we thank you for your continued trust, patience, and partnership with Montaka as we continue our exciting long-term journey together.